Growth stocks are the ideal thing, obviously, if you're starting, why not? You're going to be there for a while, you can take downturns. And if you're older, then the idea is that you should move gradually towards more conservative stocks that pay income.
Welcome to The Australian's Wealth Masterclass. I'm Julie-Anne Sprague, Wealth Editor at The Australian, and today we want to walk you through building a share portfolio. You've probably dabbled in investing, you've got some top stocks, but you want to know how to build your portfolio. Someone who knows a lot about it, James Kirby from our wealth team. James, thanks for joining me. People have probably dabbled in stocks, got an idea about it, but now they want to become a bigger, better, meaner investor.
Yeah. Want to build a share portfolio.
When we're talking portfolio, we're talking about building a number of stocks, right? So
Yes.
How much money do you think someone has to have?
The actual quantum of money doesn't really matter that much. By that I mean you can buy stock for $500, you can buy a fund for $500 or $1,000. So a few $1,000s can actually get you these days a diversified share portfolio, which is great. That wasn't always the case.
So I only need a few $1,000s, so it's pretty easy to get in and set it up.
Yes, absolutely. It is pretty easy to start. It has never been easier, and you can go onto an online broker and you can hook up with an online broker. You don't have to talk to anybody anymore. That's an upside and a downside to that. But you can actually quite cheaply buy shares. So the amount you spend is really not crucial. You can spend very low numbers to get started. The issue is trying to get a portfolio that's like a basket of interest that capture the different investments that are available.
So let's talk about that basket.
Yeah.
Okay, so, and I'm just thinking about going to the supermarket. You want to get your bread, your eggs, your milk. You need to get all of your essentials in there. So let's think about that in an investing framework. What are the essentials? What do you have to have in your basket?
Yeah, exactly. So they've invented this exchange traded fund in recent times, which has become very, very popular. And that's their whole idea. It's a basket, right? So rather than you saying, I'm going to, put all my money on whatever, washing up liquid and apples, they just give you a basket of shares, and they've got a little bit of everything. So if you buy the ASX 200 ETF, it is the entire Australian share market, all the top, that is the top 200. If you buy NASDAQ, it is the entire NASDAQ. It's very, very strong, and I think it's great for people who are starting.
So an ETF, so the exchange traded fund, so it just owns little bits of a lot of things.
Exactly.
And you're buying into that ETF. So that ETF will track that basket stocks.
It should track it absolutely perfectly. It should mirror it, to be precise, and they don't cost very much. That is, their fees are nothing like fees used to be for big funds that used to stock pick. So I think that's a very good way to start. I mean, I think when people are with a portfolio, it's not about, you were talking about how much is it, but it's really about the construction of it and how many you have. 10 to 15, I think, is ideal.
10 to 15 stocks?
10 to
or 15, would you put ETFs into this mix?
10 to 15 listed investments, right? Which can be stocks or exchange traded funds.
What if you're starting out? So your basket's small, so you think you do what you've just suggested. So I'll go an ETF that's investing in the 200 or it's an international market it's tracking. So that's in there. You're growing your investment, so you want your portfolio to grow. Is there a moment you say, okay, well, we probably don't need to track the 200. I've got 5 or 6 or 7 stocks in there now, so you can
absolutely
recalibrate.
There is. Yeah, so that depends on your frame of mind and your age to a degree. I mean, the younger you are, basically the more risks you can take. So, growth stocks are the ideal thing, obviously, if you're starting, why not? You're going to be there for a while, you can take downturns. And if you're older, then the idea is that you should move gradually towards more conservative stocks that pay income, guaranteed income as such, rather than hoping they go up through the year. So the banks famously are, 4% or so guaranteed each year.
So we'll get into the dividend yields and income stocks in a sec, but the growth stocks can be tricky, though, as you mentioned. So you have to have a bit of an appetite for risk. Now you can get some of these stocks and do fantastically well. We track them a lot at the Australian.
Yes.
We watch the stock price. We all wish we would bought early and they go up, but they don't all go up.
No, they don't all go up, and of course the ones that go up 200% in an afternoon get all the attention. The same stock might have been flat for 10 years. It goes up 200% in an afternoon and it gets a headline. So you've got to be careful about the context in which you see these. But basically growth kind of comes in gradations. So there's like growth, top line growth, where you can buy into an area where we know there's going to be growth, like AI.
Yeah.
So you got these big stocks like NextDC or Macquarie Technology. There are plays on AI, but there's still corporate companies. They're still in the top 200. WiseTech, the big tech companies. There's not many in Australia. You really have to go offshore for them.
How do you balance your portfolio? So you might want to have a bit of growth in there, but you might not want to have it all growth. So what's is there
there's
a
absolutely.
matrix?
Yeah, there is. Yeah, I mean, the ETFs again are designed that way. A growth ETF would be like Nasdaq, for instance, which is the tech stock. So that's just going to grow. You forget about dividends when you're looking at that sort of area. Conversely, if you're looking at the banks, you expect the dividends, but they may not go up in a straight line. Commonwealth Bank is a kind of a singular exception. Actually, our banks have been really drifting, going nowhere for a long time. So you got to get the balance. But the whole thing with growth is that you take the risk and you say, okay, I can make 50% here or more, and I can lose 50% here. And if you're able for that, and you won't know if you're able for it until you do it.
Until you do it. Okay, so say you've decided you want income, you want dividends from particular companies.
Yeah.
What's the best way to go about finding those particular companies and knowing which ones might be better? I mean, we talked about Commonwealth Bank. It's the outlier. But we refer to them as the big four. So you might have bought NAB or ANZ, Westpac, and you might be thinking to yourself, it's just not going to pay me as much as the others. How do you navigate this?
Well, again, we start again with the ETFs. You could pick a growth ETF, which is based on Australia or the US. Then after that, maybe you look at stocks that we know are pitched for growth, and again, they would be stocks that are tech or particular stocks that are just doing very well at this time because the wind's behind them. There with the AI stocks. If you look at if you want income, you're going to go for something quite different. The banks, yes. The whole market, by the way, the entire market is supposed to pay around 4% in dividends each year. That, all things being equal, if a stock didn't move the whole year, you'd get 4%. That's what that dividend yield is. That's the promise, if you like, from dividend yield. Banks are a bit higher than that. Property trusts also very good for income, if income is what you need.
Mining stocks depends.
Mining stocks depends. They are very linked to a cycle. So you'll get years where Rio and Fortescue and BHP will just pay marvellous dividends, beat the banks out the door. And then you'd get a period where they don't match them at all. So the banks are generally more consistent than the miners because of their commodity. Commodity cycles are what they are.
Are there common mistakes that you hear from people when they're
I think the common mistake is buying too many stocks. It really is. And the other common mistake is not getting rid of duds and not taking it on the chin. Yeah.
But just on that, so we chat a lot about this, and particularly when markets are volatile, you get told time and time again, stay. Don't sell out when everyone's fearful. You stay the course. You've made a decision. But sometimes the stock's a dud. Like
Absolutely.
It just is. So how do you recognise when your stock's a dud?
There are stocks where if it has disappointed you and it's down 60, 70%, and you notice that last year it fell 4% or it went up 3%, it's never going to come back 9 times out of 10. And often it is better just to clear the decks, assuming that is a marginal issue for you.
Well,
not the dominant
I think
issue.
that most people probably are emotional in the investments, and if there's something about that threshold, if you could just get the stock back to where you bought in at, then people will often try and cash out.
Yeah, that's
then.
right. Yeah.
But you're saying that 9 times out of 10, it's unlikely to go back to what you bought in.
It's unlikely to go back, and all the studies show this. The people are much more upset about losing money on a stock than they are happy about making money on a stock. That's just human nature. So when you look at investing really closely, and once you understand all the basics about dividend and income and growth and all that stuff, after that, what really separates everybody actually is behavior. It really is, and bias. They're the things that really make a difference in the end, and that's about buying or selling or being willing to sell, which is just as important as being willing to buy.
You reckon that's what the best investors do?
I think the best of them can think cold.
All right, admit their mistakes
I think
and
so.
move on. All right, James, thanks very much.
Thank you.